So one of the questions that was pre-submitted was, I've heard about participating life insurance as a potentially useful product for physicians. What are your thoughts on that?
So if this question is based on the podcast episode we did on this, people will know that I'm not generally a fan of the product. So I'm not a fan, and I'll elaborate on that a little bit more. This is a product that is very often pitched to physicians and other owner managers, people that have corporations, because when you die, the death benefit of any insurance policy that's held inside of a corporation can be paid out to shareholders through the capital dividend account, tax-free. The capital dividend account is a tax-free distribution. Not all of the death benefit can always be paid out through the CDA, but most of it can anyway. Details. So this is the pitch, that it's a super tax efficient thing for physicians or people with corporations for other reasons can do. Now, what is this thing? So participating whole life insurance is permanent life insurance. It's life insurance that you keep forever until you die, unlike term life insurance, which is life insurance that you hope to not die while you have the policy in force. It's like you buy it for a 10-year term, where if you died in that 10 years, it would be financially devastating to your family or whatever, but you don't plan on dying. Permanent insurance is different. You plan on dying with the policy in force. So it's kind of a weird form of insurance, because instead of insuring a risk, it's insuring a sure thing. You will die eventually. At least our generation will. I heard a very smart person say that they believe that our children will be immortal. And I was like, that sounds completely crazy. Anyway.
Yeah, that's true.
It's true that it's crazy, or true that it can happen?
I don't think it can happen, with all of the poor dietary choices or lifestyle choices people are having nowadays.
Oh, interesting.
Yeah.
Do you want me to keep going on yeah, Mark Saw says it's
yeah,
crazy.
Mark is also on the panel as well. Yeah, for sure. I agree. And he works in the ICU, so he sees all sorts of things. So in terms of the second question, like, what if someone already bought universal life insurance in their corporation? And they're incorporated. When is it still time to cut your losses and get out versus staying in and finishing up the policy?
I can definitely answer that, but is it okay if I say a little bit more about participating whole life insurance?
Oh yeah,
first?
Go ahead. Yeah.
Okay, because there's a lot that I think it's just worth talking about, because it's pitched as this like magical product, and I don't think that it's very magical. So what participating whole life gives you is the opportunity, as the sales pitch would go, to participate. And there's a bunch of jargon here, but I'll unpack it. It lets you participate in the experience of the participating block of policies. So lots of jargon, like I said, but I'll unpack it. It's like there's this group of policyholders called the participating policyholders, and they're all blocked together. They're like a group within the insurance company. And depending on how profitable that block of business is for the insurance company, the participating policyholders may receive participating dividends. And that's really the basis of the sales pitch for this product, is that it's an insurance policy that you can receive these participating dividends from. Those can be used to purchase more insurance or to pay your future premiums, or maybe some combination. And then it starts to look a lot like an investment, but it's not taxed as it grows. And as I mentioned before, the death benefit is not taxed if to the extent that it flows through the CDA, which most of it will. Now, where I think it gets really tricky is that the premiums that you pay to own this participating insurance are much higher than what you would pay to own a plain vanilla permanent guaranteed whole life insurance policy. So you're paying for this access to this non-guaranteed investment, the policy dividends. What the policy dividends are based on is when the insurance company prices the participating insurance policy, they set the premiums at a certain level based on what they expect to happen, based on their expected mortality, based on what they expect to earn in their insurance company investment account, and a few other things. If this is the experience part, if their realized experience is better than what they price the policies based on, then you get the dividends. So in a way, it's kind of like a refund of the higher premiums that you paid. And that can over time look like an investment. They're also sold because you can borrow against them, but you can borrow against any asset in a corporation. So I don't find that to be very compelling. And then there's a whole other discussion about, and I think I heard Rob talking about this, like, should you be using leverage in the first place. I don't think that owning a permanent insurance policy is a great reason to use leverage, but it's often sold related to that. One of the big things that you can always do if you're presented with one of these things is ask to see the illustration, which is the sales presentation. You can ask to see the illustration at current dividend scale minus 1%. And I would also ask to see it minus 2%. Current dividend scale is like how much policy dividends are currently being paid to policyholders or most recently. But again, those are not guaranteed. And I've seen people who have bought these policies and the dividends don't end up being as high as they were illustrated at, which can make the actual outcome that you get from the policy not as good as what was sold. And that can be not the most fun experience. Yeah, anyway, I guess the only thing I'll finish with on this is that these things pay enormous commissions. I guess that is what it is. That's how the insurance industry works in Canada. It's just worth keeping in mind, because if you go to somebody saying, I want to buy term insurance, it's going to cost you an order of magnitude less to buy that. Like if you need life insurance because of what I mentioned earlier, your family would be in trouble if you died unexpectedly, that there's an insurance need there, you can cover that with term insurance. It's not uncommon for insurance agents to say, well, hey, you should look at this permanent insurance thing or this participating whole life thing because you have a corporation, and then they go through the whole sales pitch that I just talked about. There is a paper it uses a sample from India. I don't know how representative that is of the Canadian insurance market, but you got to think the incentives are similar. They find in their sample that agents recommend products that provide the highest commissions, even if the product is not the best product for the client. And the other thing in that paper that's really interesting that they find is that consumers with lower levels of sophistication are more likely to be offered the higher commission product. So I think it's a bit of a minefield for physicians particularly. And this is something where, like, if we get we don't sell this, obviously, I guess we don't sell these types of products.
I think someone just wanted to clarify, is participating insurance different from whole life?
Participating whole life is a type of whole life insurance. So whole life insurance, that's like the idea that you're going to keep it forever. You can get guaranteed whole life, which doesn't have the participating account. So you don't get participating dividends. Guaranteed whole life, the premiums are typically much lower. Like it could be even half for the same starting face amount of insurance. But the pitch with participating whole life is that, well, hey, look, if you live for the next 50 years, your death benefit could end up being a lot higher if you get these participating dividends that we're projecting. But if you're going to sit down and buy a permanent policy for legitimate tax planning reasons, or if you have a very specific estate planning desire for, like, I want to be absolutely certain that I'm going to leave my child $1 million after tax, guaranteed whole life is a really nice way to do that. So there are cases where permanent insurance can be an interesting tool. I would not use personally or professionally, I would not use participating whole life for any reason. I kind of think like you're taking risk with that type of insurance because you're paying much higher premiums in the hope that the policy dividends will eventually pay off. I kind of think if you want to take risk, you can do it with stocks, which have positive expected returns. When you look at the numbers on stocks versus participating whole life insurance, over a long period of time, stocks look better, even after tax, unless you get very aggressive with the assumptions for the policy dividends. And I don't think it makes sense to get aggressive with those assumptions because it's not what the product is designed to do.
Yeah, and we definitely did talk a little bit about whole life insurance in Mark's talk this morning about transitioning into retirement and potentially passing along some assets to your kids as well. Mark, I saw you just turn on your camera. Did you have anything you wanted to say about that?
Yeah, I put it into the avoid category. Yeah, I love Ben's episode on that, by the way. It really clarified it. Basically, you're gambling that the insurance company's actuaries didn't quite get it right and in your favor, which anytime you buy that type of thing, the insurance companies, they're pros. This is what they do, and you're not going to come out ahead. And you have much more transparent, better ways of doing it. The only time to consider would be if you had some asset that you had to pass on to your family that they cannot sell at a bad time, like a business that's a family business or like the family cottage, and you don't want them to be forced to sell it to pay the tax bill. that would be the only time I would see it as a tool personally. But again, if you plan for it, you have other ways to deal with that are much more transparent and flexible.
That's one of the points we made in that episode, is that like, it has to be a total failure of planning for this, because there's this mythical scenario where like you just said, Mark, the elderly parents die and the family cottage has such a large tax bill that nobody can pay it, and therefore you should buy permanent life insurance. But there are many other ways to plan for that liability, especially if it's 40 years in the future. So I mean, it's kind of you have to paint these ridiculous scenarios to make this type of product look compelling. And,
well, I think anytime you make a really complex product, it makes it very good for creative marketing.
Right. Yeah.
So then moving on to like, what if someone realizes that whole life insurance is not for them, right? So when would it be a good time to cut your losses and get out? And when should you know to stay in the policy?
Yeah, so that's a tough question. And like, I had this question ahead of time, but I still can't give I can't give an answer. There's just no obvious answer. We don't typically recommend these policies, like I said, but we've had clients come in that have them. And I don't know what the ratio is of when we tell them to cancel versus keep, but there are cases where it does make sense to keep, either based on the quantitative aspects, or we've had people come in where they had bought it for a very specific sentimental reason, like a disabled child in one example that I'm thinking of, and they wouldn't cancel it even if we told them that it was the worst financial decision ever. So I think it's very case by case. There can be tax implications for canceling, which need to go into the calculus if you're running the numbers on it. But it's not a super easy thing to just say you should do this or you should do that.